All right, let's jump right into the latest financial results for OTS Holdings. They've just dropped their numbers for the first half of fiscal year 2026, and there's a really compelling story here for anyone keeping an eye on the company. So let's get into it. So here's how we're going to break this down. First, we'll hit the headline numbers, the big story, which is the shift from making a profit to posting a loss. Then we're going to dig into why the revenue fell in the first place. After that, we'll look at the squeeze on their profits. And to wrap it all up, we'll check out their outlook and how they plan to handle what's looking like a pretty tough market. Okay, let's kick things off with the most important takeaway. This is the bottom line, the number that really sets the tone for everything else in this report. And wow, here it is. In the first half of last year, OTS Holdings turned a profit of over $700,000. Fast forward to this year, same period, and that has completely flipped to a loss of $282,000. I mean, that's almost $1 million swing from the black into the red, and that right there is the central story. So the big question is, what caused such a dramatic reversal? Well, the main culprit is right here. A 15.4% drop in total revenue. Their sales went from $16.8 million down to just over $14.2 million. And when your top line takes a hit that big, it becomes incredibly tough to stay profitable. Okay, so we know revenue is down, but just saying revenue fell doesn't really tell us the whole story, right? To really understand what's happening with the business, we need to know where it fell. So let's break it down by their different business segments. Okay, so this table is pulled straight from their report. You can see the main segments laid out: modern trade, general trade, food services, and this interesting one called others. Now, as you look at the numbers from last year to this year, you see a lot of red, but one line in particular, it just jumps off the page with a massive drop. Let's unpack what these figures are actually telling us. And this is where it gets really telling. It wasn't just a small dip across the board. The real problem child was the others segment, which is where they lump their export sales. It absolutely plummeted by a staggering 54%. The company points to evolving market dynamics overseas for this. Now, their domestic sales also softened a bit because of competition and people just not spending as much, but it was the export business that was clearly the epicenter of this whole revenue problem. This chart really drives the point home. I mean, just look at that huge 64% drop in other markets. That's the export weakness laid bare. Singapore, which is their home turf, also saw a small dip. But there is a glimmer of hope here. Revenue from Malaysia actually grew by over 13%, so they do have some regional strength to build on. But here's the thing, falling sales were only half the story. The second big issue is that for every dollar of product OTS did manage to sell, they actually kept less of it as profit. This is what we call a margin squeeze, and for any company that makes things, this is a huge red flag. And this number right here, this is the key indicator. Their gross profit margin fell from 28.3% last year all the way down to 24.8% this year. That is a really significant drop, and it basically means the core profitability of the stuff they sell has gotten weaker. And just as a quick refresher, gross profit margin tells you how much money a company makes from selling its products before you factor in all the other corporate costs like marketing or admin staff. A nice high margin is what every business is shooting for. So why did the margin shrink? Well, the company says it was mainly because of lower production volume. Think about it like this. A factory has fixed costs, right? Things like rent and keeping the machines running. When you're making and selling fewer items, those same fixed costs have to be spread across a smaller number of products. That makes each individual item more expensive to produce and, you guessed it, less profitable. Now, to their credit, the company did react by trying to control what they could. They did a good job cutting marketing and distribution costs by over 20%, and they trimmed their admin expenses by almost 10%. But one thing they couldn't escape was rising interest rates. Their finance costs shot up by almost 29% because of new bank loans. So, that's the diagnosis of what happened. Now for the important part. What's the plan? Let's turn to the outlook and see how the company is planning to navigate these choppy waters going forward. And the company is being very upfront about the challenges they're up against. We're talking about inflation, which is driving up the cost of everything from raw materials to labor. They're facing fierce competition, especially from those supermarket house brands. And on top of that, all the global uncertainty plus stubbornly high meat and shipping costs are just making everything harder to predict. So what's their game plan? Well, it seems to be all about control and long-term thinking. They're tightening their belts on costs across the board, trying to squeeze more efficiency out of their production lines, and keeping a very close eye on every marketing dollar spent. The big strategic move, though, is getting their new factory in Malaysia ready for a full launch. They're hoping that's going to strengthen their operations and set them up for future growth. So, to wrap it all up, OTS Holdings is definitely facing some major challenges with revenue and profits, but they seem to have a clear plan focused on controlling costs and making smart strategic investments for the future. We'll definitely be watching to see how these moves play out over the next year. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.